First of all, thanks to everybody for coming today. It's great to see so many familiar faces and a few new ones as well. And I truly consider all of you partners. I know it sounds very germane, but it really is meaningful to have everybody in this kind of support here. So next, I'd like to thank the forum team, everybody that made this possible. My analogy is it's like a duck, on the water. It looks like nothing's going on underwater. They're just swimming like hell getting this done. So thank you guys for making this happen. A ton of work went into this, and just like everything we do at Forum every day, it's not easy, but this team makes it look easy. And I promise you, there are many people up very early and very late to make the wheels go round. So thank you to everybody at the Forum team. Next, thank you to my wife and family for their support, and to my mother, who actually was my first investor back in 2003. So my dad passed away about 8 years ago, and elementary school principal, and they always believed in me. And excuse me, she's been with me for everything I've ever done, and can't thank you enough. So thanks, Mom. What's today about? Today is actually all about you, our partners here, learning about Forum, where we've been, where we're headed. I want this to be fun, educational, and informational. It'll be interactive, so as questions come up, please raise your hand when there's a pause. Then we have breakout sessions for our acquisition group, development, investment management, and Forum capital advisors. So lots of changes going on in our world, so it's happening at such a rapid pace. It's hard, even somebody at my age, to know what to do. My little kids take my iPhone and tell me exactly how to figure things out now, and they're 10 and under. We're going to start off with Dhar, Sawh. He is with YARDI Matrix. It's really interesting to watch the shift from millennials to the baby boomers and housing trends and where people are moving to. The socialist movement, I'm not getting into politics, but there's a lot of reasons why people are moving. The biggest immigration in Colorado is coming from California, Illinois, and New York. And so as we look at lifestyle and just the way we live today, it's so different than when I grew up. I mean, we went on vacation, but like my folks were never moving. They actually still live, my mom still lives in the house I grew up in. Versus today, whether it's taxes, meaning property, income, lifestyle, where your kids are living. So we'll get into some of that. That's a little bit of foreshadowing. I don't want to steal Dhar or anyone else's thunder.
Hear me? All right. Well, good afternoon, everyone. It's good to have you right after lunch. Everyone had sugar. Right? As I was looking at the picture, I started to realize that it looks like I have the same jacket and the same shirt on. So please don't think I only wear this everywhere. It is different, trust me. So as Shelby talked about and Darren talked about, I'm here today to just give you a quick overview, macroeconomic outlook, talk about multifamily, and then talk about, as Darren mentioned, these shifts that are going on within the industry as we see this, and where those shifts are happening, where they're coming from, where they're going to, and hopefully give you some insight for your future investments perspective. So let's jump right into it. And I like to start with the answer first. So if after this you guys want to get up and get another cup of coffee, you're good. The economy is in good shape. We had GDP that came in stronger than we expected in the first quarter. The second quarter, they always start low. We expect that to ramp up. The yield curve is the only big risk that we see out there. It inverted briefly in March for a couple of days, but has reverted back. It's kind of flat right now. We'll talk about that. And the labor market is pretty tight. So the economy is still doing pretty good. Notwithstanding, last week and this week, there's some volatility. Now that's around the trade negotiations that is going on. You see that volatility. But the fundamentals of the economy are pretty solid. The big message today is that there is this secular changes that is impacting multifamily. It's impacting the entire United States, but it's also specifically impacting the multifamily. We have a big demand generation that's coming through. We think it's north of 425K. With multiple factors, aging population, higher divorce rates is creating independent households. We have millennials who are starting to step out, creating their own households. So there's multiple factors that are driving these new household formations that will drive the demand for multifamily units for renters. And on top of that, we have the shift that Darren referred to. So what we're seeing is that both the population and companies are looking for lower cost alternatives to live and work in. All right, so typically the shift is happening out of traditionally large gateway cities into what we call tech hubs. They're considered secondary or tertiary markets, but there are a lot of tech hubs. And the reason I say tech hubs, we want to be specific. It's not every secondary market that's going to see growth or see these people moving into them. There are specific ones that have some fundamentals that foster the growth within those cities. And so that's what we'll talk about today. All right, so let's jump right into it. As I said, the economy looks pretty good. Consumer confidence is an all-time high. Q2 forecast is 1.3, but we see those ratchet up over time. For Q1, it started at 0.9, went forward, and the Q1 numbers came out significantly higher than what they were projecting. So we're projecting that we think the Q2 will come over somewhere just above 2.1%. So the economy looks good. We did invert slightly in 2018 on the yield curve. This is the biggest risk we see, but it's bounced back. Actually, it bounced back and today it's flat. When I looked at the 10-year Treasury note today, it was 2.41, which means it's absolutely flat. So that's something we'll keep an eye on from an economy perspective to see if that stays or inverts and stays inverted for a while. It could be a sign that we might be headed to a small recession. From economics or market perspective, we're doing well. Now, we had some volatility this past week, but if you go back to December, we had some lows in the market. S&P 500, the Dow took some big hits in December, but they've regained all of that traction since then, right, and actually gone past it. So a lot of momentum there. From a Treasury note, the yield curve I talked about, that's what we'll look at. At the end of the day, if you look at bonds across the world, U.S. is still the safest place for money, still giving the highest yield, right? Italy's up there, but there's a lot of risk, right, from that component. So we'll still see a lot of capital flowing to our industry, for sure. Inflation continues to be low, unusually low, actually, because we've had job growth, we've had wage growth, but it's been low. And so we started taking a little deeper dives. One of the things that surprised us was the cost of education and healthcare actually has been coming down. That inflation number has been coming down. So that was an interesting component. So we're not seeing the inflation that we thought. The other thing is oil has been what I call range-bound, right? The U.S. has become a net exporter of oil. So what happens if the Saudis say we're gonna crank down production because we want to see the prices go up? If the prices go high, the U.S. can flood the market with oil because we're a net supplier now. We can actually keep a tab or a cap on that oil number. So really, that's another thing that's keeping the inflation number low. And really, the inflation is a global phenomenon. The low inflation is a global phenomenon. We have excess capacity across the world. So it's not that we're unique from that perspective. So there's been low inflation across the world. As I said, the yield curve is flat. I think those are at 0 bips right now. If I looked at today's numbers, this is the risk that we'll keep a track of. The other component is that the labor market is very, very, very tight. We have less than one person to fill each job opening that's happening right now. That's pretty tight, right? If you look at the numbers that have been coming out, April numbers were a huge surprise, right? Especially starting off in January and February, where those numbers were low. They bounced back and really is really really, really strong. What this has the effect of is that you have to go find the labor, right? And you're going to pay a little more. And what that has the effect of, another effect is you're going to pull people off the sidelines, people who are maybe partially employed or were thinking of, I'm retired, I'm going to stay on the sidelines. You're going to go search for those folks, bring them back into the workforce, right? So we do see good things on the labor market. That puts upwards pressure on wages. So we have been seeing wage growth. The nice thing that I think we can get out of this, we haven't been seeing wage growth that is inflationary. It's been nice and steady, right? Some in many markets might say it hasn't been fast enough. And that might be true, but we are seeing wage growth that is happening. From a participation perspective, we're seeing, that there is still some room to pull some of those people off the sidelines. The employable people or in the market versus employed, we have some room to pull those up. The other key thing that's happening, the older generations are coming back into the workforce as well, right? People living longer, they're living healthier, and don't want to sit around in a nursing home necessarily. They want to be active and out, and so they're working longer. And then this is also part of that generation that you see that influx into the renters that are coming back into the industry, right? An interesting, did I not click it? Yeah. So an interesting note here, since the recession, or since 2015 actually, the participation among women has been much higher coming back into the workforce. So that's a pretty interesting note as we go forward here. One of the, I would say, things to look at is also fiscal policy, because fiscal policy also affects our industry, right? And if you look at the current administration's policy, they have anti-growth elements to it, which you guys see in the news all the time, and then there's pro-growth elements to it. So one of the things, as Darren said, I'm not here to make a political statement. I'm just telling you what are things going on so you understand what's going on, right? Is that they're using the pro-growth elements, tax reform, regulatory relief, executive orders, mostly a lot of oil companies you're seeing being relieved of regulations, to facilitate the anti-growth stuff, all right? And immigration is a big one there, right? So the limiting of immigration could have an effect on our industry. That's also one of the big reasons we're seeing such a tight labor market, right? Normally immigration comes in, you're able to at least flood it with a lot on the lower end, but also on the upper end, and you can relieve some of those pressures on the labor market. Because there's been such a reduction, you're seeing those pressures and tightness in the labor market coming in, right? Again, let's keep an eye on this. I would say the administration is walking a very, very fine line, right? It wouldn't take much to go either way. Rounding out the economy, we think, economy is strong. I think the biggest thing to watch here is the yield curve, is really what we're going to be watching going forward here. Jumping into multifamily specifically, we have a boom of renters coming. There has been a boom since the recession, and that boom has been sustainable. It keeps coming. And what's adding to that? The aging population I talked about, people working longer, staying healthier longer. Unfortunately, divorce rates are up, or are up. That's adding to formation of new households, bringing people into renting. Young people living longer at home. I have a 20-year-old who goes to college and is at home, and I have no idea when he's going to move out. It's kind of scary. So I can definitely see that one, right? But student debt is definitely a restriction from getting out and buying your own home, stepping out on your own. And then there's lifestyle changes. People are having kids later, getting married later, things like that. So all of these combine to give us a surge in these renters. If we looked at it from an age perspective of since 2000 to 2018, almost 600,000 new renters. We expect that to be about 410,000 going forward to 2030. Divorce, young people living at home. So as the economy gets better, As people get jobs, the labor market's tight, you're going to pull people off the sidelines. As those folks who went back home now find better jobs and they come out, stepping out, forming their own households, that will also add to the renter nation, right? So we have to see that unfold. Like I said, I'm skeptical with my son, but we'll see. And then lifestyle changes. People are delaying getting married, having children, so on and so forth, right? We'll add to that. If we broke it by age group, interesting thing here, you guys can read the slides. I'm not going to read them for you. Look at the 65 to 79 and 80-year plus, the percentage increase that we've seen, right? That's a big increase. Now, the 45 to 65 or 64 years, yes, we did see a decrease, but what happens what's going to add to that number is the divorce rate. Unfortunately, is going to break that in. That's not typically a renter cohort. Those are the folks who normally have bought a home, moving out to the suburbs. So, lots of evidence that we'll have the renters coming. If you look at it, every one of these cohorts have increased their renter percentages, the amount of people renting. Right? Even the older demographics are renting more from across the board as you look at it. And by the way, I am flipping through these very, very quickly. So if anybody wants the slides after, I think we can facilitate getting you these slides. I know I'm just throwing data at you. So another thing is home ownership, or families who had previously could afford higher rents had gone out to buy single-family homes, right? And they were out of the renter nation, or the renters. But we're seeing those folks with a higher income coming back. And as you can see that you can see the absorption rates that are happening in Class A properties across the board. Yes, we're topping out a little bit, but we believe there's another wave coming that we're going to see another build-up or deliveries that need to ramp up to meet that demand. From a home ownership rate, that has been falling. I think it peaked just before the recession, but they've been falling across the board. And if you look at these major markets, it is falling across the board. And then these are the Denver, Portland, these are all areas that people are leaving the houses and renting across the board. So we're seeing these coming on. People are working longer, as I talked about. Interesting, look at the 65-year plus between 1985 and 2018. Pretty big numbers, even the 55 to 64-year-old group cohort. A lot more people working longer. Divorce rates, we talked about this, continues. I kind of preempted my own slide. That's okay. Pent-up demand, again, goes back to those young people. Here are the numbers. It's a lot of people who are living at home. I want to kick my son out, and so to have him go and do his own household formation. So we believe these are going to unravel as we go forward. The other thing that has been keeping a damper on people going and buying houses is the student debt crisis, right? These folks graduate early. Even renting sometimes was hard, right? They had to pay those student loans. And so that debt kept them from either buying or renting, and that will start to unfold as the economy gets better as we go forward. Adding to that, more and more evidence, adding to that, the cost of owning or acquiring a home has been rising steadily, right? And as you can see, it's been the 20% down, but it hasn't been all the case. Our view, right, this is just our view, YARDI's view, was that even though the numbers said that the peak there happened in 2006, 2007, that it took a lot of money, I don't believe that is true, because what was happening then? That was a subprime, 0% interest, 1% interest. It was very easy to get loans. So our view is that there was a artificial boosting of people buying homes during that period, but that seems to be coming back to norm right now. All right? People getting married later. I think we all see that, right, in our daily lives, for sure. and they're also having children later. Right? Definitely movement on that period, or that piece. Working longer, more dedicated to careers, having kids a little later. What's interesting is that even the folks who migrate to the U.S., when they come to the U.S., they tend to fall towards the U.S. mean on the number of kids, right? So they do have less kids. So the fertility rate, as people come in, has been dropping. So overall, we're dropping from a fertility rate perspective. But as you can see, it's broken out by the demographic areas there. Yeah? And it stopped working. No. Okay, having said all that, we believe the rentership rates will level out. From a rate perspective, how much people are renting, or what percentage of people are renting. But remember, the volume of people is much higher, so the percentage is much more meaningful from even if it's leveling out. Household formations, again, has bounced back. We see it. People are starting to come out and form new households, so we expect that to ramp up. And really, from a delivery perspective, from a supply perspective, it's late in the game. Going back to the recession, when we started to come out to the recession, people started to form households, but we weren't building. We weren't delivering at that time. And we recently started to catch up with those deliveries. And if you look at it, we have a backlog of about 2.5 million units. Right? Now, we have caught up a little, but we still have another wave to go. We still have to fill that backlog. So what does that tell us? That tells us is we're going to be in a supply constraint environment, right? So there's going to be the need for units that are just not there. And what does that mean for us is that we have to build more. But if we look at the pipeline right now, 2018, after 2018, we see it tailing off. There's multiple reasons for this tailing off in deliveries. You have construction costs is one. Permitting has been slower by cities. Zoning requirements have been popping in. A lot of cities are trying to exert density control or zoning control. And so there's lots of reasons why deliveries are tailing off. But this just tells you, even if we deliver at the rate we expect, we're not delivering enough, right? We're still going to have some gaps. If we looked at the pipeline that we are having, we have 21% under construction right now. 25% planned. Even the constructions, we have delayed deliveries, so planned are going to even be more delayed. Prospective is, I got a piece of land, maybe I'll do something. So that's even a little more speculative from that perspective. What does it all mean? Okay, I must be at the wrong angle. If we have a supply constraint, what that's going to give us is that we're going to see some steadiness in rate, right? Because if we don't have enough units being supplied, rates will continue to go up. Now, rates, if you look back, have bounced off the lows in 2017 and really have leveled out and stayed steady at about a 3% gain over every year. And look at occupancy. Occupancy, yes, these are variations, but if you look at the scale, it's not that much of a variation, right? It's going to be steady. So we expect this rate to continue to be from this perspective, about 3%, simply because we're going to continue to be in that supply constraint environment. So we talked about on top this shift from gateway markets to secondary, what we call tech hub markets. So here's a layout of what we're thinking, and then those tech hubs, secondary cities, we call them overlooked cities, but this is where we see a lot of activity happening across the board, right? And then we have some tertiary markets as well. But the tech hubs is where we see the activity going on. From a job growth perspective, if you look at the percentage job growth against the pure numbers, you can see the cities that really have really good growth also in the numbers. The graph I like is this one, right? This one I'm mapping the employment growth against the unemployment rate. And what it does, the cities to the right of the green line really have room. Even though they're getting good job growth, their unemployment is a little higher, so they can they absorb those people. The cities on the left, especially at the top, are tight, right? They're getting great job growth, but their unemployment is already low. So what do those cities have to do? They have to try and import talent, right? They have to attract somebody from somewhere else, right? Can I get somebody coming out of New York City or San Francisco or New York, right? Can I bring that talent to me? And they have to fight to get that talent. So one of the studies we did, CBRE had conducted a study for Amazon when they were looking for their second headquarters, right? And they were looking for tech talent. And I thought this was really interesting. So we took that overlay that they did and we added all of the tech hub cities that we have. And what it was, it says, where can I go in the country to open up that second headquarters? Where can I move to operate at a slightly less cost? However, I want to find that quality of those employees, that labor, but at a more reasonable price. And so that's what you're seeing here. And you see, San Francisco, yes, I have exceptional talent, but I pay an exceptional price for that talent, right? And so what companies are looking for is they're looking for where can I go and find still very high quality of the labor, but pay a much more reasonable cost for that. And that's what you see here. And this is what's fueling a lot of companies as they look out of where do I go, right? Where do I find those employees, those high-cost employees, or lower-cost employees for the same quality? So that was the jobs. Now, if you look at population growth, and there's a lot of cities here, the main thing for you to notice on here is that population growth is happening in those non-gateway cities. So what are cities appearing up here? Austin, Orlando, Raleigh, Dallas, Nashville, right? People are moving to these cities. So again, finding that low-cost city to live in. So you continue to see the growth. So you've got the job growth happening in these tech cities. You've got people moving into these tech hub cities, right? And so that's where the population is going to happen. Now, along with that, there's a natural flow, a natural evolution or movement that happens within the country. I'm not sure if you guys are aware of this. You probably are aware, not really say, well, that's my main focus, but from a population shift that happens, there's a natural flow of people coming in, immigration, international immigration coming into your typical gateway cities, LA, New York, especially coastal ones, San Francisco. I'm a good example. So we migrated, me and my family, we migrated to New Jersey, right? And when we got to New Jersey, after a while of working, we bought a house. And it was all of us, right? Typical immigrant story. There was 8 of us in the house. And only 2 bedrooms, do the math. But, you know, after I went to college, graduated college, and I said, okay, I want to form my own household, right? I wanted to step out. On the salary I couldn't afford on my own, you know, to be in my own in New Jersey. So I had gotten a job offer here in Denver. So I moved out here to Denver in 1995. If you're from here, you know it was affordable then. Right? It was a very different story then. So, and so that is what happens from a very natural perspective, right? When we left, we sold our house to another immigrant family. So that's a natural process that happens, that you have outflow migration from those gateway cities. And if you look at the cities, these are the typical tech hubs that we are looking at. You have also that natural inflow from immigration that comes in as they start to form their own households. So there's a process to this as well. This is also why I point out the whole immigration issue up front when I talked about fiscal policy, right? That's important, because if that gets constricted, those gateway cities might be at risk. You have to look at something there. In summary, apologize, strong outlook for multifamily as we go forward. How am I doing on time, Darren? Okay. Things look good. We don't see any big hiccups. We have strong demand coming in. We don't see a pipeline of deliveries that's going to meet that demand anytime soon. In fact, we believe there should be a second wave coming up pretty soon here to help start to fill that demand that's coming, that's unfolding as we speak. So there's good things, and an economy being good at the back end of that is really good as well, and support. So as we talked about these tech hubs, we have been studying these tech hubs, and some of these, let's say Denver, for example, have been, you might say, well, or if I'm going into a city, what are the key things that attract people to the city? What keeps them there? What makes that city grow? What makes that city prosperous? So we did a study, and it was a combination that we looked at the prior mayor of Pittsburgh, along with a book called Who's Your City, and worked through these 4 quadrants as to what makes a city vibrant, what makes it grow, what brings jobs to it, what makes it really tick. And there's 4 things we identified that was true across all the tech hub cities. First one was public-private partnerships. So how much was private entities willing to partner with the city to help develop that city, right? And you guys have been seeing these revitalizations that are going on across the country, right? Denver was early in it. Pittsburgh was first, right? You're even seeing downtown Cincinnati being revitalized, right? So cities are happening all over. Second is, how friendly is that city to the business? What are they doing to attract businesses to their city and keep them there, right? Third, how educated is the workforce in that city? Why is it important? It's intellectual capital. The educated workforce is what brings the ideas, what brings the innovation to that city to help foster the growth, right? That's going to drive those cities. And last but not least, it's what the community amenities are. That's what all the new employees want. I don't want to walk more than a mile to my work. I want to walk within a mile to my workout facility. I want to have bars and restaurants. I want to be, even if something is a little far, I want train or transportation very quickly to where I'm going. Those are the requirements of the new employees coming in. And it's actually having a dramatic effect on office, right? I don't know if you guys have seen the latest office layouts. There are more common areas, right? They're not cubes as much. They're more glass walls instead of dry walls on the offices, right? I like to joke that there's 5 different coffee machines because people want 5 different coffee machines and employers are willing to do it, right? So those demographic, those secular changes are changing the way cities operate because people want to have everything around them and not have to travel very, very far for it. So, as an example, what's going on in Denver from those 4 quadrants? Well, we all know about the DIA and the public-private partnership that's helping to rebuild that. Kind of scares me. I go to DIA maybe twice a week or once a week at least, and now to go with 80 million people. But, I guess it's good, right? Denver is ranked number 8 in the nation for attracting businesses from an incentive perspective, right? Aside from BP, we have multiple institutional research companies coming into Denver as well, really pulled in by those incentives. We have a very educated workforce, right? We got great universities around here that generate a lot. And we've always been an attraction from a live-work-play perspective. But it's getting better, right? You guys, I don't know how many of you were surprised at all the development that happened downtown since, I don't know, last time you've been downtown, right? I get down relatively often and still seeing new things. So it continues to grow and adopt. And again, what is going to be common is that you're going to see a common theme of this live, work, play, where you're going to see developments that are happening with residential, office, retail, and sometimes even educational space being built out, all in the same area. And if they're connected by transit, even better, right? It makes it really, really attractive. Now, transit, I would say it's a density thing. If you're in New York or LA or a very dense area, transit's important. If you're in a more suburban type area, San Diego being a good example, not necessarily transit oriented, you can drive to everywhere, right? So those are some common themes. And so what that leads to is that outside of the core downtown, everybody knows about the core downtown and how it's built out. But what we're seeing in these different tech hubs is the emergence of what we call intellectual capital nodes. What is an intellectual capital node? It's the convergence of industry or a concentration of industry that is supported by intellectual capital, meaning universities, and then if transit is oriented around it, even better, right? So companies are moving to these hubs. So everybody knows about, Broomfield and downtown Denver. The tech center for the longest time has been a really good technology hub, but and you've seen the development along the 36 corridor going up towards Broomfield and Westminster. In fact, the development are now starting to move just north of downtown Denver as well, right? And those two are eventually going to meet. So even in a city that you might be considering says, well, that city's built out. If you look beyond the CBD, there are nodes that pop up all over the place, and that's where the opportunities exist from an investment perspective. If we look at wages in Denver, yes, since the recession, there's been a big gap. Wages have never caught up. But if we just take it from since 2016, they actually have kept pace, right? So wages are coming, maybe not as fast as we like, but they are coming. Denver has strong rent growth. What is nice about this, if you look at the classification, is strong rent growth across categories. Lifestyle, think of that as the A-plus properties, renters by choice, right? And then a renter by necessity, of course, is more towards your workforce housing type renters. Occupancy, again, you see a lot of fluctuations in the graph, but if you're looking at, within 1 basis point of movement, so rents are pretty steady. Where do we see the top 5 submarkets forecasted for rent and occupancy growth? That's within just that the Denver area, and those are located there. Like I said, mostly north and west is we're seeing a lot of development there. Now, another tech hub that's developing or trying to develop is the one by Aurora campus, excuse me, out by Colfax. So that's another area that we see some, because that's a hospital that is going to have a university aspect to it that can help facilitate growth. Apologize with my throat. I was up in New York speaking for a good while yesterday, so apologize. Denver, I think you're doing pretty well if you invested back in 2008, right? So no question about that. Our completions have peaked in 2018. Well, it really jumped up after 2017. But again, same deal as we look forward. Going out, those completions are petering out or not as much, right? And people might say, well, Denver is oversupplied. Currently, yes, but we're seeing the demand, as I laid out, start to unfold as well. So that's going to create that next wave, right? Where is the development happening in Denver? Pretty spread out, but you're starting to see it. You have the main core tech center to the south, and then to the north and the west. You can see a lot of development happening there. Planned. Under construction just means you've broken ground. Planned means I filed a permit with the city at some point. I'm somewhere in the permitting process. Just so you know the difference between those two. Top 5 submarkets under construction. Wouldn't surprise you the most that you have the most number of units within the CBD. But as you go a little north, you'll see those construction numbers really kick up as well. Another city that we like to highlight today is Dallas. That we see these public-private partnerships happening. They have been very, very aggressive in trying to attract businesses. You know, number 3 ranked in the nation of friendliness to business environment. That's good for them. Very educated workforce as well. Good universities around there. And then they have been developing that live, work, play environment as well. The interesting thing about Dallas, if you look at the intellectual capital nodes, Dallas, or the general Dallas area, the metro, has always been a very pocket-oriented market. And it's kind of interesting that as we see this in our tech hubs, Dallas really has shown us the way that these have formed over the years, right? Everybody knows about downtown, Fort Worth, and Irving. Probably you knew those, right? Those are pretty standard. But you talk about Frisco and Allen and Plano, who's come on strong in recently, starting to show those areas of development where these intellectual nodes are happening. Right? So again, even cities that you think might be, oh, it's late to get in or things like that, there are areas within there that have opportunities for them. Atlanta is another one. They have been really going after businesses to get them in there. Now we'll see what happens after this bill is signed, with, you know, how many withdrawals we get from that. But they have also been a big push on affordable housing as well. Right? So public-private partnership to help facilitate affordable housing. And again, huge number on educated workforce. From a tech hub perspective, again, everybody knew about downtown and Buckhead. But the areas that really are popping up is Sandy Springs, Alpharetta. In fact, YARDI has an office actually more closer to Alpharetta up there as well. So we're seeing as companies form their secondary, third offices in these tech hubs as well. Hopefully you're starting to get the picture that there's opportunity out there. If we looked at forward, what are the big sub-markets and markets that are going to have forecasted growth for rent and occupancy? Actually, this is just rent growth. You start to see those names, those familiar names pop in there, right? Salt Lake City, Dallas, Orlando, Las Vegas, right? Some of them are overflow. If you look at Sacramento, Sacramento is really an overflow from San Francisco because people can't afford to live in San Francisco anymore. They're flowing out to Sacramento, and Sacramento is getting that big spike. They have a shortage of supply. They haven't been pushing things in there, so that's why you see that big piece coming in. So anyway, again, the growth is going to be happening in these secondary tech hub markets. Am I doing this wrong? From a transactions basis, transactions have been pretty level, pretty steady, not big year-over-year changes, but the great news about that is that they've been transacted at a higher per unit value. So even though it's less transactions, we're transacting at a higher per unit value. And the reason is simple, right? The rates have continued to rise. Valuations continue to rise, cap rates continue to stay low, so it's hard to find a deal. Actually, let me retake that. It's easy to find a deal. It's hard to pencil a deal, right, to make it work. So that's the key, right? Can I find a deal to make it work for me? So those are the things that, you know, as investors, those are the things that you're going to have to go after and pencil them. And I think the tech hubs is where those opportunities exist, that you can get that. So again, capping out is that the economy is strong, continue to be strong, and then from a multifamily perspective, we've got great fundamentals, right? We could use a little more supply, but still, we've got good fundamentals going in over the next few years for us. So we don't see any big dips or hiccups. I think it's good news. All right. Well, that was my presentation, folks. Hopefully, that was beneficial for you. Thank you.